It's time for the Your Personal Bank Show with Ferenc Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with your personal bank. Now here's Ferenc Toth.
Welcome to the Your Personal Bank Show, and today we got a great show. I've got some fun stuff to share. I'm going to be sharing a lot of information from folks that I've been working with this past week. Like I said, I've been kind of sharing that more and more because, well, I mean, it's a fun thing to do, of course. And two, there is absolutely no question there's been a major uptick in activity. I've always been busy. I've been at this, like I said, this is my 23rd year, actually. And the personal bank concept I've been working with for the last 7-8 years now. And it's always been consistently busy and a good business and, help a lot of people make a difference. Like I said, grow their money, create positive arbitrage, reduce market risk, reduce their taxes, all that good stuff. But again, and I can really attribute it to when the inflation numbers came out a few weeks back, I think that got in the tax concerns a lot of people have, that has got a lot of folks' attention. And as well it should. Those are two of the things that could really make a dramatic difference in our economy and our economic situation. I mean, currently short term, things are looking great overall because, we're coming out of the COVID shutdowns, businesses going again, people are getting back to work. A lot of places throughout the country, not everywhere, but most of the country. So there's a lot of good recovery stuff happening, a lot of positive economic news. That's all great. And absolutely, I hope it continues to move that direction as I anticipate it will. Of course, things like inflation, because there's too much money circulating in the system, could really be a real economic downer. That could really impact things, cause interest rates to climb. It can cause stock market to go down. Historically, that's what's happened. And of course, a significant increase in taxes can really have a tempering or reducing effect overall in the market, the economy and the market and all that kind of stuff too. So you take that double whammy, so to speak, of taxes and inflation, that's a cause for concern. Again, it should be a cause for concern, a major one. So I'm going to share a few thoughts, a few stories of folks I've worked with just this past week. But again, the first thing, if you didn't hear it and you missed it last week, we do have a new bank on board. In fact, next week, we'll be interviewing one of the major folks involved with that bank. So we're going to hold that. So stay tuned. But a lower rate, 3.25% interest, which is awesome. Again, we're have companies are paying dividends, 5.75 to 6% dividends. Have never, consistently over the last 25 years plus, never missed a dividend since literally before the Civil War. And my point is quite simple. If you're getting 5.75 to 6% dividends today, which you can get with underlying guarantees, tax-free, all that good stuff, all right, long-term history, and you leave it in the policy, of course, high cash value policy, your cash is going to grow. You're going to earn those dividends. Money will grow. If you then want to access those funds, which, for any reason, frankly, and you access them through the bank line and you're getting charged 3.25%, for example, you're looking at a 2.5% to 3% positive arbitrage situation, because we actually have we have several different banks we can work with, several different insurance companies we can work with. And like I said, the dividends are between 5.75 and 6% today. And the bank lines are between 3 and 3.95. Most of our situations are 3 and 3.25, by the way. So you could get as much as a 3% positive arbitrage scenario, at least 2.5 in most cases, between 2.5 and 3. Now remember, folks, the key to this is that's on money you spent. That's on money you've allocated and used elsewhere. So never forget that, because that's the real power to the personal bank concept. Now, what are some examples of some cases that have happened this past week? Well, some clients I've worked with. I won't share any names so that nobody, I'm not going to identify anybody or anything like that. But those that are listening, they'll know who they are. They'll recognize it. And I know a lot of my clients and new clients a lot of times get a kick out of hearing their story of why they decided to move forward with this. So a couple of them this past week were particularly interesting. One was we got approvals. Now, I was really excited about for a couple, and the wife, she's 78, husband 74. And this is important because, of course, they're a retired couple, and a lot of folks, a lot of times contact me, and they one of the comments I hear is, well, I'm too old for this. I'm past my prime or whatever like that to get the insurance or qualify or whatever. Folks, these folks are in their 70s. And the numbers worked. In fact, they worked very well, and they were superior to any annuity product we could provide for them. They were obviously looking at supplementing income for retirement. I mean, that was their goal. And annuities, a lot of times people turn to annuities or bonds or various instruments like that, income-producing assets, to do that for them. And we were able to, again, the numbers were superior in many ways. Well, the numbers were superior in terms of the returns, in terms of being tax-free, in terms of liquidity. That's one of the big knocks on annuities. Not that I'm against annuities. They have a place. They have a purpose. But one of the big knocks on any annuity, for the most part, is lack of liquidity. Most of them only allow 10% per year in access. Well, in their case, in fact, their liquidity day one on the 78-year-old is 85%. 85% liquid of the funds she's funding is available and accessible to her day one. The other big thing, though, money growing tax-free, access to tax-free, that's important. But the other big one for this particular couple was the money's available for long-term care type of expenses. See, a portion of that death benefit is available for long-term care, type of expenses. You don't have to be in a facility. You don't have to submit any bills, okay? Bottom line is the doctor just has to say you're in need of assistance, and those funds are available. And folks, that's powerful because statistics show that the average retired couple, their number one financial risk is long-term care expenses. And so this really helps them offset those expenses, that risk, and they can be protected from that. And like I said, I always say this is one of the best in my opinion, one of the best long-term care type programs for an individual, and for someone to protect themselves from long-term care expenses, I should say. And the reason why is simple. It's built into these products, all of these. If you need the money, it's there. It's available. If you don't need it, well, you didn't pay any extra for it. So what could be better than that? If anyone's looked into long-term care insurance, for example, they know it can get quite expensive, especially as you get older. Somebody in their 70s, it's going to be very expensive, okay, for the typical individual. So this was very powerful and very positive motivation. And I know some annuities have riders that can help offset long-term care type expenses, but nothing to the extent that these high cash value policies do. There's no comparison. They're not even in the same league. So again, for somebody wanting to grow their money with safety, consistency, wanted to reduce their taxes, wanted to have liquidity, access, and use of the money if and they need it. Oh, and don't forget, they're picking up this particular situation. They're picking up 2.5% positive arbitrage. So when they do access the money, this is what's interesting. Think about that a minute. If you're accessing the money like this couple intends to do, to supplement income for retirement, and the dollars that they access and take out each month, they then pick up the positive arbitrage right now of 2.5%. Is that money you can get any other way? In other words, if they take $1,000 a month from this account, for example, and they pick up 2.5% on that interest that they earn each and every year for the rest of their lives is extra money that they'll have available to then be able to spend to supplement further retirement. That 2.5% positive arbitrage could be looked at as a cost of living increase, if you will, even. And remember, again, folks, don't ever forget this key point. It's on money that's spent. This is on money they're actually accessing and using and supplementing retirement with. And they're still earning some interest on those dollars. Look, I have a simple question to ask. And this is a powerful one, a very powerful question. But if you want your money to last longer, you want your dollars to go farther, I'm going to ask you this question. Are you earning interest on any dollars that you spend? See, the answer for most people is no. And you got to ask yourself, why not? Why am I not earning interest on money I'm spending? Because isn't that, if you picked up some interest on some of those dollars, wouldn't that just be more dollars you'd have available? And the answer is, of course it would be. So look, if you're not getting interest on money you spent, you really should contact us at yourpersonalbank.com. I'll be happy to talk to you about it, send you more information, share with you how this can really enhance your finances, maximize your financial future, ensure you have more money to spend going forward and through retirement. Even if you already are retired, like this couple, like I said, that just this past week, we ran all the numbers, we compared them to all the annuities and other options were out there. The gains were superior. The dividends were superior. The guarantees were superior. Tax-free is superior in just about any scenario. But the last piece is that positive arbitrage. That's unique. Can't get that anywhere else. Again, earning interest on the dollars they're using to supplement retirement. And don't forget, if they have long-term care type of expenses, they're going to have extra money for that. What else can offer those kinds of things? All of those scenarios. You see, in fact, this was one of the things, and I did talk about this situation briefly in some previous shows, but like I was talking with the husband and wife, and they were ready to submit. They'd actually funded an annuity with a different company, and after listening to the show and then me sharing with them what this can do, the personal bank, to supplement their retirement, again, all those benefits, they decided, hey, if we can qualify for this, we don't want the annuity, and I completely agreed. I said, look, if you want an annuity, I can help them get the best rates and all that kind of good stuff that's out there right now, again, to create a guaranteed income, which is what they were looking for. Again, they're in their 70s, they're retired, they're looking for income to supplement retirement, right? So my point was, look, if we can get you approved, I couldn't guarantee it. We had to run, they are in their 70s. There were some minor health issues, nothing major, but it wasn't perfect, clean health, okay? Don't fall under that misconception that you have to have exceptional health. Okay. That's not true. But I said, look, if you can get qualified for this, I would much prefer you get this because, again, it's superior in so many ways in terms of the dividends you're earning, the tax-free benefits, the liquidity. Again, 85% liquid day one. There's no annuity on the planet that'll offer that I'm aware of. Okay. And extra additional dollars for long-term care expenses if they ever need it. That's powerful. Tax-free, powerful. But again, earning interest on money they spend. So when they take those dollars out and supplement their retirement, they're going to still earn interest on it, which means they'll have more dollars to spend and supplement their retirement going forward each and every year. Folks, that's powerful. Stay tuned in the next segment. I'm going to talk about some other scenarios that are very interesting that happened this week regarding your personal bank.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we're talking about some interesting cases I dealt with this past week, in fact. Before I get there, don't forget, we have a new bank. If you missed it last week, lower interest rate, 3.25%, and higher access, 100% access to the cash value. So if you missed it, go to the previous shows, yourpersonalbank.com, or contact me at yourpersonalbank.com for more information. What that does creates even greater positive arbitrage. We are now seeing 2.5% to 3% positive arbitrage with most of our clients. And again, it depends on your dividend rate that you're going to receive, which is going to be in the 5.75% to 6% range today. Again, companies have been paying that for the last 25 plus years. Never missed dividends since before the Civil War. Don't forget, that's tax-free too, so always keep that in mind. That's strong. Secondly, when you leave it there, you earn the dividends. It's just going to grow. But then you access the funds through the bank line. The interest rates on most lines now are going to be 3 to 3.25%, depending on the situation and the amount of funds. The highest will be 3.95%. I'll just tell you that right off the bat. But my point is, in most cases, most of our clients are now seeing 2.5% to upwards of 3% positive arbitrage on their money when they spend it. Remember, that's the key. You're earning interest on money you spent or allocated elsewhere. Which brings me to actually two separate clients this past week. There were both referrals from existing clients of mine. And in both of their cases, these folks had decided and actually were wrapping up cash out refis, or they were both cases, I'm sorry, they had sold properties. I'm sorry. They had sold real estate properties and were receiving the proceeds from these, okay, in the next few weeks. So the point is they were looking at a chunk of money, in both cases, a fairly significant amount of money coming in, and they were looking for what to do with it and where to invest it and things like that. Now, in both of their cases, they were one was looking at paying off some debt, paying off some bills that they have. The other was looking at putting it away and then looking at investing either in a future business or perhaps other real estate deals when the real estate market, as he put it, felt like got a little more favorable. He felt the prices are kind of high right now. So in both of their cases, they want the money to grow, of course. They want to have access to the money, liquidity. All right. They need to use that money maybe with paying off the bills in the very short term, with the business or real estate investing maybe in the next year, like he said, the next year, 2 or 3, he anticipated. So these are both folks that are coming into a chunk of money, are going to have need for use of a significant portion of that money in the very near future or relatively near future. Obviously, in both cases, they weren't really willing to risk a whole lot because, with market risk and such, because again, they have need of these funds, right? So the personal bank was very appealing to them. And the misunderstanding both had, that I had to clarify when I talked with them, was, remember, the tool we're using to earn the dividends is a high cash value insurance policy. And in both cases, they're like, well, tell me more about this. This sounds different. And it is. It's much different. Look, if you have 85% access to your cash day one, that's way different than what most traditional insurance policies look like. In fact, that's the knock on insurance a lot of times. 2 knocks I hear all the time. People say, well, if you put the money in, a lot of times you'll have little or no cash available day one. In fact, many cases, not even for the first 3 or 4 years even. Your cash value will be nothing or next to nothing. And again, that's how a traditional insurance policy works. That's not what we're doing. We're adding specific riders that are free, that create a significant increase in cash, upwards of 85% day one. So, for example, one of these clients they're getting $300,000, for example, proceeds from this house sale. And they're looking at putting the entire $300,000 in. They're going to have access to, well over $250,000 of it day one. Look, there's not many guaranteed financial tools out there that allow the liquidity of that. You can think about CDs and annuities and various things like that with safety, but they don't have that kind of liquidity. But even more important, and this is what was really appealing, again, in both cases, these particular cases here, was the ability to then access a majority of those funds, but on top of it, still earn some interest when they access those funds and use them elsewhere. See, that's the true power of the personal bank concept. Look, all of us spend money, right? We have expenses, we pay bills, we have debt, we buy things, we invest in stuff. I mean, that's true for just about anyone, okay? And in these 2 cases with these 2 clients, here's what I said to one of them. In fact, I even mentioned that to him today. I said, these proceeds are coming in a few weeks. He goes, yeah, I've got some bills. I want to take some of the money from and pay off the bills. And I said, certainly you could do that. And he goes, I wanted to look to invest the rest. Obviously, that's one way to approach it. That's the more common, what most people are familiar with. But I said, here, I want you to think about and consider another option. I'm going to run the numbers both ways for him so he can see the difference and how it works. But here's what I said. Here's what I want you to consider, because this really truly shows the power of the personal bank concept. I said, what if you put all the funds in the personal bank policy? And then you're going to have access to around 85% of those dollars available to you day one. And he didn't need the entire 85% to pay his bills, but I said, now you take the portion you were going to use to pay that debt off, but you access it through the bank line of credit. And again, in his situation, his positive arbitrage will be 2.5%, which is the most common scenario I run into. And I said, so you're going to put the funds in the policy, in his case, it was 5.75 dividend. This was the best scenario for him. and he can access it through the bank line at 3.25. So he picks up the 2.5% positive arbitrage and pays those bills off. Now I said to him, what's the difference? And the difference is simple. He's going to earn, if he took that money and paid the bills straight out, paid off the debt straight out, yes, he got rid of the debt. That's a good thing. But he gave up those dollars to do it. In other words, those dollars are gone forever, aren't they? What kind of interest will he earn on those dollars going forward? The answer, of course, is zero. Nothing. Nada, right? So instead, I said if you put it in the personal bank policy to earn the dividends, then access it through the bank line of credit and pay off those bills. Still going to pay the bills off, which is good. But on those dollars now still continue to earn the difference, 2.5%. And what if that's the average positive arbitrage the rest of his life? We're talking about positive arbitrage the rest of his life. Folks, he was in his 40s. What is that going to look like for the next 30, 40, 50 years? 2.5%. I mean, in 10 years, it's 25% more money without any compounding, right? He's like, yeah, I see your point. Look, he's got a choice. He can pay the bills off, take the money, pay off the bills, or he can take the money, flow it through the personal bank, access it through the bank line, through the policy, access to the bank line, and then pay off the bills and pick it up 2.5% a year off of those dollars. Well, he could have potentially make enough interest back over time to actually get all that money back, couldn't he? I mean, it's extra money in your pocket that you wouldn't have any other way, right? So you might as well pick up what you can, let your money go further, right? Look, if we are going to be dealing with inflation and things like this going forward, it's going to be very important for our dollars to work for us and last longer and go farther. So I'm going to encourage you to stay tuned for the next segment, because we're going to talk about the next scenario and also tie this in about the idea of how do we make our money work for us and last longer and go farther so we have more of it. Okay, again, if inflation does kick in gear, that's going to be more important than ever for us to have our money work for us like that. So stay tuned in the next segment. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Today we've been talking about some cases I've worked with on folks this week. So if you missed it, I'm going to tell you, we had how I was talking about the first segment, how older retired couple, they're both in their 70s, in fact 74 and 78 happen to be their ages, got approved, ran the numbers to supplement their retirement, and this was superior to any annuity we were able to find. And like I said, I work with over 50 annuity companies, so there was more money for them than any annuity could provide, plus more liquidity, plus tax-free versus tax-deferred, plus long-term care benefits, monies for the long-term care type of expenses if they need them, and a death benefit to boot to go to the survivor. So when you put all that together, you know, that you just can't, and I almost forgot, probably the most important part. I mean, the liquidity is important, the extra growth's important, but the positive arbitrage probably is going to be, depending on how long they live, could be the biggest difference, okay? So I want folks to understand that don't think you're too old to get this. Like I said, I've had folks now this past week successfully, positively approved, qualified, all that, age 74 and 78 with not, average health, nothing exceptional, nothing bad. So my point is, certainly worth looking into. And if you're looking to supplement retirement and enhance your retirement dollars and make them last longer, go farther, get some interest on some of those dollars you are spending to supplement retirement, you really should contact me at yourpersonalbank.com. And like I've been mentioning in some of the first segments too, is don't underestimate the insidiousness of inflation. Inflation can be something that really, really ugly and really hurt buying power and the strength of the dollar and all those kinds of things. So your personal bank and getting that positive arbitrage and having your money last longer, work more for you, go farther, could become more and more important as time goes forward. So my last situation or case I was talking about, my second one was folks that had sold a prop or were getting the proceeds from a property sale, and were needing the money to pay off some debt and then wanted the rest of it to grow. And I showed them, again, if you missed it, go to yourpersonalbank.com. You can listen to the previous segments or any of the previous shows, and just showed them how their dollars would last longer, go farther, get the positive arbitrage, and still pay the debt off, which is awesome. The third case situation is similar, but a little different. Again, proceeds from a house sale, getting a chunk of money in, and as the comment was with this gentleman was, and it was a referral from an existing client, he's like, I thought, from his referral, they're funding, he said, how am I going to fund this calculate how much I'm going to fund over a period of time? Because the folks that were referring to him, he was related to them actually, that's how they're doing theirs. And I said, well, there's two primary ways of funding these cases. Is what the one people are more familiar with is where you fund it, monthly, annually, quarterly, whatever, over a period of years. But you can also do what we call a front load, where you front load, pay most of the premium up front, and you dribble in a little bit after that, but most of it goes up front. And when you're getting a chunk of money all of a sudden, like this gentleman was, that can make an awful lot of sense. And he's like, yeah, I see what you mean. He says, but I do still want to build something for the future also. And I said, absolutely. In fact, what we may do is actually two separate policies. I do this often for folks where they have a chunk of money they want to work with to do a front load, as we call it, and then a second one where they fund it over a period of time to build long-term cash growth. Why not do both? And so that's one of those things that we deal with on a regular basis. And he's like, well, how much should I calculate to put in? I said, well, let's go over your numbers, go over your situation, and I'll help guide you in terms of what's some amounts that make sense. And the thing is about it is when I do this with folks, it's not me saying, look, this is what I think you should do. I come up with a number or amounts that make sense, in my opinion, and then I explain to you the reason why. So in other words, there's a well thought out process in the amounts that we come up with that makes sense for each individual. Okay. And of course you can agree or disagree. You can increase or decrease those amounts, what you feel comfortable with. That's entirely up to you. The point is, I would rather see you do something a little bit less and be comfortable with it and have success and continue long-term success than to try to overextend, so to speak, and try to do too much. The ironic thing is, what's funny is because a lot of clients get really excited about growing their money tax-free with guarantees, getting the positive arbitrage, all that good stuff, all the things this offers. And I often have to talk them down a bit. I'm usually talking them into a little bit less than what they were wanting to do. Because again, I'd rather see you have long-term success and not be stressed out about this, if you know what I'm saying. Let's make it easy. Let's make it a no-brainer, if you know what I'm trying to say. And it's something that doesn't negatively impact your lifestyle. The thing is, by putting it in and getting positive arbitrage, the liquidity factor and the growth on the money just makes everything better. So I'm going to encourage you to stay tuned in the next segment, because I'm going to finish up with that on how it can really enhance your financial situation and make your money last longer.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Okay, we're going to wrap this show up today, and we've been covering some situations I've been dealing with with clients this past week, actually. I highlighted 3 interesting cases that I dealt with. One was an older couple, retired, both in their 70s, in fact, age 74 and 78 for that matter, who qualified, got this done. We ran the numbers. This was superior to an annuity in terms of growth, dividends, what they're earning, interest. Far superior in liquidity, 85% liquid day one, by the way. That beats the socks off of any annuity out there. Included funds available for long-term care expenses if they needed them. So that was all built in, no extra cost for that. So that was a very powerful key. Also included a death benefit for the survivor. So if something did happen to either of them, the survivor, the husband and wife team here, of course, they would get a nice big check, okay, which would supplement loss of Social Security income, things like that. And tax-free, of growth and access, which is, again, far superior to any annuity. And again, I'm not negative on annuities. They have a place, they have a purpose. But in so many ways, your personal bank can be a superior alternative to supplementing retirement. But the last, and probably not least, is the positive arbitrage. In other words, by funding the policy and earning the dividends, 5.75 to 6% dividends today, long-term history of that, plus 25 years, never missed a dividend since before the Civil War, and then accessing the funds at, in their case, 3.25% interest. We can get as low as 3 in some situations. My point is, we're picking up 2.5% positive arbitrage in their case, 2.5%. And folks, that's powerful. That really is what makes your personal bank so different. Whether you're using the money to supplement retirement or to pay off debt, like my second example I talked about today, or to use it to purchase a business or other real estate in the future as an asset investment tool, which was my third example today. The positive arbitrage in all three of those cases was the big factor. I mean, there were other reasons that were positive. Again, the tax situation, tax-free is, hey, look, tax-free is better than taxable or tax-deferred any day of the week. I don't think anyone can argue with that. But it's that positive arbitrage. That's what's so powerful. The key is, and like I said, most of my clients today are now getting 2.5% positive arbitrage. Look, if you can pick up 2.5% on money you spend, okay? If you spend 10 grand a year, okay? I mean, that's not a lot of money. Let's be real. I mean, most households spend an awful lot more than that, okay? 2.5% would be what? 10 grand to $250. If you spend 100 grand, it's $2,500, right? But it's not just 1 year. See, a lot of people say, 2.5%, that's nice, but that's not life-changing. Well, here's what starts becoming life-changing. Add that up over time. Compound that over a decade or 2 or 3. Folks, now we're talking about real money. We're talking about a real serious amount of money. And the larger, the more you do, the more you invest, the more you spend, the bigger the positive arbitrage, the amount you get can be. And the thing is, in just about every single case I've ever dealt with, you aren't going to get that positive arbitrage, that interest, any other way. In other words, you had already decided to spend that money somehow. You were supplementing retirement, paying expenses, whatever. You were buying things with it, or you were investing with it. My point is, you were already planning to or intending to allocate those dollars somewhere else, out of your pocket into someone else's, right? You're giving that money to someone else, again, to pay off a debt, pay off a bill, buy something, invest in something, whatever. Once you do that, once you give that money, you hand those dollars over, you transfer those funds. Those funds, here's the key thing you need to understand about money and financial literacy and the power of taking control of money over time and truly changing wealth generationally, frankly. This can change wealth generationally. Not just for you, but for the next generations of your family. Look, by keeping control of some of that money and keeping that positive arbitrage, what are you doing? You're earning interest on money that's, well, frankly, you spent. You gave to someone else. Now think about that a minute. What if you were in a situation where you earned interest or gained returns or whatever it was you get on investments like you do now, but now on top of that you add some positive arbitrage, some interest gains on all those dollars you gave to somebody else or invested elsewhere or invested in something. I mean, if you look at it from an investment standpoint and you're picking up 2.5% positive arbitrage, aren't you just adding 2.5% to your ROI, rate of return? The answer is yes. Look, I don't know about you, but most people I deal with, an extra 2.5% would be a significant increase on their rate of return. Look, if you're making 10% ROI, rate of return on average, look, long term, I mean, I get it. Some years people can make really good returns, but I'm talking about consistently over time, over decades. A 10% average rate of return, most people, I think, would be quite happy with. especially if you consider that after tax. But that's a whole nother story. My point is, if your ROI is 10% and you add 2.5% to that, that's a 12.5% rate of return. Folks, that's significant. Folks, that's a 25% increase to your average rate of return. Look, if you were looking to buy two assets, two investment vehicles, or two investment properties, or whatever it may be, I don't care what the investment is, and one was going to give you a 10% ROI and one was going to give you a 12.5%, and everything else was equal, which one are you investing in? I mean, that's a no-brainer, isn't it? That's an obvious question. Well, how about using the personal bank to give you yourself that advantage on every single investment you do? What if instead of buying an investment because you feel like that's a good investment for whatever reason, why not flow it through the personal bank policy, access it through the bank line of credit, and fund that asset and fund that investment, and give yourself a leg up? Give yourself a 2.5% boost to your rate of return, because then that's what you're going to do. That's the result. Are you going to have more money? Are your investment returns going to be greater? Folks, it's math. Absolutely. You're going to increase it, by a significant percentage, right? I mean, that's the power of this tool. That's the power of your personal bank. So again, if you're an investor, I'm going to encourage you to contact me at yourpersonalbank.com. Get some more information and be happy to share with you how this can increase your investment returns. And folks, if this is something that you're not familiar with, I hear that too. Well, I haven't heard about this before and all these other things. Well, that's part of the reason I'm doing this show. It's a specialized area of the financial world. There's no question about it. Most financial advisors, through no fault of their own, are barely knowledgeable, if familiar with this at all. They don't have the experience, the background, the knowledge. They were not exposed to it, whatever the reason may be. I know I wasn't for many, many years. And when I was, through banking contacts and things like that, I recognize this is the kind of thing that needs to be out there in the general public. It's just not. Now, thankfully, slowly, it's starting to seep into the public consciousness. I'm running into more and more people that have been exposed or introduced to this idea, at least, and more who are actually even using it. Folks, if you're using it, by the way, I have an interview coming up soon with a gentleman I met who's been using this tool for the last 10 years. Very smart, astute businessman, met the right people who steered him in the right direction, and he's been funding a significant amount of money into this for the last decade. And when I met with him, of course, I was like, that's awesome. That's incredible, because he was a referral. And I said, normally when somebody's been funding one of these plans for a decade plus, he built so much cash value and the cost of insurance is less when you're 10 years younger and all that it's typically not financially beneficial to switch after you've been doing it for that long. Well, unfortunately for him, the company that he had worked with 10 years ago had been a good company, but unfortunately their dividends had dropped from what they used to be. And so we were able to get him increase his dividends by an entire percent, from like 475 to 575, folks. That's huge. Plus the cost, the new company had lower cost of insurance and everything else, even though he was 10 years older. We ran the numbers both ways. I said, let's just run the numbers I want to see. And surprisingly, they came out quite favorable. Quite a bit more favorable for him to make the switch. So he did. I'm going to be interviewing him coming up this next week, so I encourage you to stay tuned. My point is, this is a financial tool that can not only change your financial future dramatically for the better, it'll make your money last longer. Folks, if you believe inflation is going to be an issue going forward, or could be an issue, significant factor going forward, you need to look into this, because you need your money to last longer in most cases. Most cases that people I talk to, they're going to need their money to go further. going to work more for them, work better for them, and enhance the returns. By picking up some interest on money you spent is a powerful way to accomplish that. And really, your personal bank's the only way to accomplish it. And here's the thing. It's basically painless. I mean, let's think about this a minute. Let's be real. When you invest, there's a trade-off. When you take some money to invest, you're taking money away from your current needs, current expenses, right? Or things that you need or want now, and you're trading them for something, a future date. It's a delayed gratification, right? And there's a balance there you have to maintain of how much do I take away from my future wants and needs and build for my future wants and needs. And that's a tough balancing act oftentimes. Well, your personal bank can actually help alleviate some of that. In other words, you can actually put money into this, access funds from it now, and still pick up some return on that money. So not only what happens is you can actually manage or maintain or even enhance current wants and needs, expenses, and put some away for the future to enhance what you're going to have down the road. It actually helps with that whole balance. It actually creates a situation where you have more money available to you now and in your control, which I'll talk about. I'm going to talk about that in the next show, so I'm going to encourage you to stay tuned. But the thing is, you have access and control to more money now than you did before without negative repercussions. And I mean things like taxes, penalties, surrenders, all that stuff. And be able to use those dollars, but not give up all the future growth. Yes, you do give up some of the future growth. So I'm not saying you should go whole hog on this all the way and spend all your money now. I'm not saying that. But what I'm saying is you can spend some of it. You could spend some more of it than you were now and not kill the future. That's extremely interesting. And again, with higher inflation, that could be a critical factor. The difference, in fact, for some people of whether they have enough for retirement or not. Whether they're going to run out of money before they run out of time, right? And inflation can be an insidious thing that can really eat into that. So again, I'm really going to encourage you more than ever. Contact me at yourpersonalbank.com. I don't care if you've not heard of this or not familiar. It's a new idea. It's a paradigm shift in thinking. I get all those things. But different times require different results or different actions, don't they? So it's at least worth looking into. Check it out. Contact me at yourpersonalbank.com for more information. I'll be happy to share with you, again, how this will enhance and change your financial future for not only yourself, your family, but also your business. And as long as it's on our money, I'm just going to say this, in God we trust.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.